So hi, I'm Archna and I run ArchnaTrades.com. I have Discord trade alerts, but here we are in earnings season. So I thought, why not discuss different types of earning strategies? Um, Earnings are exciting, earnings are uncertain, right? But then uncertainty and events create opportunity. So let's see what kind of option trades we can learn from, um, you know, in this presentation. So let's go ahead. So before I start, disclaimer, trading is risky. Any trade setup or anything that I am presenting here in this webinar is for educational purposes. It's not intended to be financial advice. These are just examples of the kind of trades I do. And so please make your own decision and risk the capital that you're willing to lose. Okay. And after the disclaimer, something about me. I am a contributor at Leduk Trading and I run an advanced options Discord channel for her. I also run ArchnaTrades.com, in which I have an options mentoring program, Discord trade alerts, and I write a paid daily pre-market Substack called indexincome.substack.com. So every day pre-market, what the ES and the NQ can do, where they can go. And since we have 0DTE SPX options now, I try to come up with the option trades that are for cash flow purposes. So these are some things that I do. How I got started, I'm a technical trader. I learned, like everybody initially starts, okay, trend lines and looking at Fibonacci trend lines, Bollinger Bands and everything, RSI. And then I came across, I did a course and I learned from Dan Sheridan, who is a CBOE market maker. I learned how to look at option Greeks and deltas, looking at volatility and coming up with strategies as an income tool. So I learned to do a weekly, bi-weekly calendar trades to make 10%. And those were more like, sit for half an hour on your computer, come up with a trade, and you just need to look every day. Okay, do I need any adjustment? I don't. And then you go and go play your golf. Those kind of trades I learned from him. And they were cool. I got to see options, premium, where it can change, how it can change. But I could not forget my, chart drawings and the RSIs and everything. So I combined those two things and I've made something of my own. And that's how I trade. I have a system. So for this presentation, I'm making some assumptions that you know a little bit more than just buying calls and puts. You have some knowledge of what are debit spreads, what are credit spreads, and you know what is a delta, what is theta, and what is implied volatility. Okay, so with those assumptions, we can go in for earnings trades. So why am I saying that? Ultimately, right, when you buy a call, you have the right to buy the stock at that particular price, at your strike price. When you buy a put, you are having the right to sell the stock at a particular price. When you short a call, you have obligated to sell the stock at that price. And when you are short a put, you are obligated to buy the stock. When we combine, ultimately, we have only these four things that we can do: long call, long put, short put. But you can do all sorts of combinations with them. Okay, you can buy one long call, short two calls. Okay, buy two calls, short one call. You can do all kinds of permutation, combination, and combine these together and come up with strategies. Why would you do that? Why make it so complex when you can just have one long call or a long put, right? But by making it feels complex because you're adding legs to your option strategy, but by doing such things, you are taking advantage of the volatility. You are taking advantage of the premium decay that options provide, right? You can also trade sideways market. If you do not combine, if you just buy a long call and it doesn't go anywhere, every day you are losing premium. So how do you get around not losing premium every day because of theta, because of time decay? So combining these help you to mitigate all those issues, okay? So let's look at it. When you're using options, you're using a leveraged instrument to trade your bias, correct? When you buy a call, you are bullish in direction. When you buy a put, you are bearish in direction. When we combine different options, we are using the option Greeks, and hence we are taking advantage of that leverage that options provide, and we can reduce our risk actually. If options are a leveraged way to trade stocks, then combining multiple options and strategies is an efficient way to trade options, okay? So you're talking about efficiency on a leveraged product. So that becomes more capital efficient. You are becoming more capital efficient when you are combining multiple options, okay? Now, earnings is an event, right? So there can be a build-up phase. Everybody is anticipating something, right? Right? So there is a build-up phase, then the earning happens, and then there is collapse. This is how the volatility works also, because you're anticipating, right? Suppose you're going for a very, Hawaii or Alaska cruise, build up, right? You're building up excitement to go there. That excitement happens, and then when you come back from vacation, you feel down. So there is IV collapse. Here there is IV rise. The event passes, then there is IV collapse. So you can trade around this in three different buckets. As as earning is approaching, this is the build-up phase, then the earnings trade, and then you have the post-earnings trade. So you can do three different types of trades on a single stock based on this. So usually, okay, so that's what you're saying. You have a pre-earnings trade, then during earnings you have, and then you can have a post-earnings trade. Now, after the earnings happens, there are three different ways it can work, right? You have a gap up and go, okay? You have a gap up and fade. You have a gap down and fade. You have a gap down and go. So these four different ways the stock can react, okay, after earnings. So now, yes, if it's a gap up and fade, okay, you can buy puts. But what you are doing when you're buying put the next day in the morning, at that time, the entire IV has not yet collapsed. So you're buying expensive puts, okay? And then it needs to make a bigger move for you to make some gains, because you bought an expensive put because the IV was higher, okay? So we will go through different strategies that I do, okay? So for pre-earnings, usually 1 to 2 weeks before earnings, stocks go higher in anticipation, okay, of some good earnings. If you're expecting something good to happen, that excitement, people are hopeful, companies are going to beat the earnings, so they want to front run it, or they want to buy before the good earnings come out because they think that pop is going to happen. So this move or this anticipation usually takes the stock higher. For that, you can buy calls, okay? Now, which calls you buy makes a very big difference, okay? Now, if earnings is on August 4th, okay, I'm just giving August 3rd, next week, earnings are there. Airbnb earnings is August 3rd, okay, and you think for 2 weeks it's going to run, okay? So you are buying, say, August 4th, you buy August 4th calls. No, that doesn't, if you buy August 4th calls, you can buy August 18th calls, correct? Or you can buy July 28th calls, right? This week's call. Which one do you buy? Okay. August 3rd is the earnings. Buying August 4th calls is the only one that I would consider. Or August 18th or September. There's no point buying before the earnings, okay? The expiration before. Why? Because the IV, we were talking about the anticipation, which takes the IV higher. So for these 2 weeks, okay, IV is building up and the maximum IV jump happens in the expiration cycle. So the IV can keep rising for August 4th. So even if the stock is not moving higher, okay, the daily theta decay, the time decay that the option usually experiences, that is offset, okay, by the volatility rise. So your premium holds up better. So if today is not July 25th, if it was June end, okay, and you were thinking that I want to go for this 3 weeks into August, okay, if it is first week of July or whatever, right? And there are 3 weeks to go for Airbnb earnings and you want to go long, rather than buying July 28th, which is one expiration cycle before the earnings, right? Go into the expiration cycle, right? When the earnings is there, that expiration cycle holds the premium the best. So that's when you can buy just straight up calls or straight up puts based on whatever your bias is, and you can take it. Now, the way I do this, okay, if I am bullish on a stock, so I'm just giving an example, okay, if Airbnb, I am bullish on Airbnb, I would buy August 8, okay, I would buy August 4th, say 150 calls I've bought. I think it goes beyond that, okay? And I get it to run into this. And then the day of earning, before its earnings, if I have profit, I get out. If I think it is going to keep running even after earnings, my bias is really that bullish, I would make it a free trade by selling a 155 call against my 150, okay? I'm just giving random example, okay? If I bought it for say $5, okay? 150 calls. Now Airbnb ran up and now it's at $6, okay? So then what I would do, I would sell the 155 call against my 150, okay? And suppose I am able to sell the 155 call for 520, okay? Which means I paid $5 in the beginning. Now I'm getting 520 for it. So instead of taking the $1 profit and closing the trade, I am taking only 20 cents profit, okay? But now I have a free trade. I have a 150, 155 call debit spread, which is free. I didn't put any money in it, okay, for earnings. So now I have a free earnings trade. If Airbnb goes down after earning, what happens? I don't lose anything. Instead of making $1, I made $20. Okay, instead of making $100 per contract, I've made $20. Okay, and now, but if it goes up to that 155 area, I can make $5. So I have put zero money in, and I have a free earnings trade that I have a potential of making $500 on. Okay, so pre-earnings trade, configuring a pre-earnings trade in the expiration cycle where the earnings is, or after that, helps you to, if you are right, you do not have to roll it to another trade. You can convert that long call or a long put into a different strategy and make it a free trade for your buyers to still work. Okay. That's one way of trading pre-earnings. Okay. Now let's see, Airbnb, FT&T, Monster, and FND have earnings next week on 3rd, okay, after market closes. So based on what FOMC does, right, tomorrow, I would still have 1 week left. So if the market holds up after FOMC, maybe the strategy that I talked about, I can work it out with Monster or Airbnb. Okay, so I can take August 4th calls, as I said, okay, I can take August 4th calls and see to it that hopefully it runs, okay? If it runs, sell something against it, make it a call debit spread, free one, and I'm able to have a free trade. Market, I'm not putting anything in. So you have to understand I have zero risk. Now, when you have zero risk and the potential to make $500 per contract on it, you are looking at infinite gains, right? Infinite percentage gain. Okay. Okay. Somebody's asking questions. Okay. No. Can you hear, guys, right? No sound. Okay. People are able to hear.
That was just one person that.
Oh, okay.
The sound is transmitting fine.
Okay. Sorry. So then now let's look at, we talked about the pre-earnings trade. Now, what about earnings trades, right? We talked about implied volatility building up, being high, going into an event. It's an anticipation. It's uncertainty. You do not know what the earnings is going to be. Okay. So you are buying expensive options. When you buy, you are buying expensive options, which means that it needs to do more than what is priced in. Okay. So for example, today we had, after close, we had Microsoft, Google, and Snap earnings are going to be there. Okay. As of yesterday, okay, I'm talking about Monday, okay, end of day, Snap had 281% IV, which means, okay, 281% IV means that you're buying so much expensive, and it had an expected move of around $3. Okay. So let's go ahead and see what it did. Okay. So here I'm showing, due to the implied volatility of 281%, Snap must make an outside move for your directional calls or puts. Not necessarily after earnings, everything goes up. If the earnings are not good, the market doesn't like it, it goes down too. So whatever your directional bias is, if you think it's going to go down, if you think it's going to go up, any directional call or put you are taking, it needs to make an outsized move beyond that for your calls or puts to make any money. Okay. This means that the options are very expensive. Snap has done previous outside move, right? Last time, I think it fell 20% or something. Okay. Because it does outsized moves, that's the reason the IV, the market maker knows that these kind of moves happen in this stock. So they jack up the IV even more. And people think, oh, Snap is a small stock, right? The price of the stock is $12. How much can you lose, right? But they don't understand that you're buying an expensive option. The volatility is pricing in a big move because it has done it before. So here, selling options should be much better, okay? So if you look at the option chain, then you see, okay, what I'm trying to show here, Here it's 281, 180, 144. Okay. So unless and until you come to September 15 and below, if you look at it, right, you're having everything above 100. So even if you think, okay, July 28th, earnings is higher, IV is higher. Instead of going here, I'll go to next week. The IV is still high. So you would have to go here if you want to just buy calls or just buy puts. Okay. You would have to go beyond September to just buy calls or just buy puts, just based on IV. Okay. Now, so this expensive options, when something is so expensive, what do you think? When you think that the stock has gone way higher, you sell, right? So when you think that due to the volatility, the option premiums are at its peak, you would want to sell premium. So there are selling strategies for earnings. Let's go through them. What kind of trades can be done? Okay. So I'm just showing this for Snap. Okay. It was at 1268 yesterday. Its market maker move was around $3. Maximum gap up it has had ever, okay, is 43%, which is around $5.50. Maximum gap down it has had a 32%, which is around $4. Okay. So that means you're talking about, yes, this 281 IV is definitely worth it, in the sense that the market maker knows that these kind of moves can happen. That's the reason market maker has jacked up the IV so high. So let's think that, the expected move is coming to 9.96, which is the range. This is the median. Okay. 10.7 is the median down move that you are expecting. Okay. That if I don't mind buying a stock here at 10.7, so you can have one trade idea. Okay. You can sell 11 puts for July 28th for 65 cents. Okay. If you are bullish Snap earnings, you do not mind getting put the stock, which means that if Snap is below $11 and you get put the stock, you do not mind owning the stock, then one strategy could be you sell puts, 11 puts, and get 65 cents credit for it. You would be putting 338 margin per contract. Okay. So if you are getting put the stock, what would be your cost basis? You will get the stock at 11 because that's you're doing, right? You're selling 11 put, but you got 65 cents credit. So it's going to be 10.35 is going to be your cost basis. Okay. Because you're getting 65 cents credit, 11 minus 65 is 10.35. So even if it goes down, okay, your cost basis is only 10.35. Okay. If you do not mind owning Snap at 10.35, this could be one way. If Snap goes higher, you keep the 65 cents credit that you receive. You can keep that. By Friday, this 338 margin will be released and you made $65. Okay. In a couple of days. If it goes down, if it stays where it is, then also you can keep. If it goes down below and you get put the stock, you are fine with it. And your cost basis is lower than just buying a $11 stock. Okay. That's one way to trade earnings, because regularly, if you go, you are not going to get 65 cents credit for that. You are getting that much credit only because the IV is high. Okay. So that's one. You could do other selling strategies are straddles, strangles. They require a lot of margin. I do not want to go into those kind of trades here. These are not, that is not what I'm going to be teaching here. Okay. Let's look at what other. another trade idea, if you are bullish, okay, if you're bullish and you do not want the stock to go, okay, and if you think, if you're bullish, but you do not want to get put the stock if things don't work, okay, so you are bullish, but you do not want to own the stock, then you can do an earnings calendar or a diagonal. You can sell July 28th, okay, because those premium is very high, right? You can sell the July 28th calls because the IV is high, the options is expensive. So sell an expensive option, buy a later dated call where the IV is low. So for example, okay, you could sell the 16 call here, July 28, where the earnings is. And then you are buying a call, okay, in August 18th, which is only 125 IV. So this collapse in IV itself accounts for something, okay? Even if Snap does not go higher, okay, the IV collapse itself will keep your premium and you will be able to get out with 10 to 20% profit, okay? So you could do this. You could buy a 14 call in August, sell a 16 call in July 28th for 64 cents for a low risk trade. If you are bearish, you could do the same on the put side, okay? You could have sold, okay, you could have sold the July 28th, okay, 11 puts to buy August 18th, 13 puts, okay? You could have configured a put diagonal also if you are bearish. If you're bullish, you could configure a call diagonal. But what does this do, okay? So selling 16 calls for July 28th expiration to buy August 18th, 14 calls for 64 cents, you are paying a debit. Your call that you have sold, okay, expires before, which means, see, you are owning, when you buy a 14 call, what you are saying that you are willing to own Snap at 14. When you sell a 16 call, or you are saying that you're willing to sell at 16. You're buying at 14, selling at 16. You're buying low, selling high. So it's just a debit trade. It does not require any margin. And this is like because you're right to own the stock at 14, okay, last till August 18th. So you own the stock for a longer time, and then, but you're selling in this expiration itself, okay? So with this trade, the most you can lose is 64 cents. It's just the debit that you paid. If, okay, Snap closes below 16, then the short will expire worthless. You are still long 14 call for August 18th, okay? So these are different options, okay? If Snap goes to 15.8, then the trade will be profitable and almost double. If Snap is at 13, then you lose the entire premium that you paid. If Snap goes to 17, which means it is done the maximum, maximum gap up of $5 that it has done before, if we do that, then also your trade will be profitable and almost it will be more than a double. Okay, so these are different ways to trade Snap. But I saw that these were trades that I came up with yesterday. Snap has fallen down. Okay, so let's see what Snap is doing. Okay, so Snap, if you think about it, okay, it's gone down. If you had done the earnings calendar, you are losing money. If you had bought the calls, you had Okay, to buy the call, you would have lost the entire premium of almost $2 or so that you must have paid. Okay, if you bought a $14 call, you would have paid more than 120. Okay, so you would lose the entire 120 if you had bought August 14th call. If you bought a calendar for 64 bucks, you lost the whole thing. If you sold the 11 puts that you got 65 cents for, okay, it is right now at exactly your cost basis. Okay, so tomorrow, if we gap up, if it starts to go higher from here, okay, you would still be able to get out for profit. If it does not, if it is here and you get put the stock, you can go ahead and sell it. Okay, that's your cost basis, so you're still not losing anything. Okay, even though it went all the way from 1350 down to 1030 to 1035, if you just sold the put because of the IV and your cost basis is 1035, you are not losing anything yet. If it goes below this, yes, you are losing. Until here, you are not losing anything. Okay, so that's just what I'm looking at. Let's go back to our presentation. Okay, so if you think that the IV is too high and you think that snap is going to be within the expected move, it's not going to go outside the $3. Okay, which it is doing. Okay, it expected $3 and it was at 1268, which means you are expecting the low to go to around 9 or below 9, or it had, so the options had priced in, okay, a move to almost 950 and a move to almost 15 bucks, 1550. Okay, so as long as snap is in between these two levels, the IV collapse itself is going to take care of all the premium. Okay, so you could sell a strangle, sell a straddle, you could sell iron condors, sell iron flies. These are different ways to take advantage of high IV. Now, when you are selling strangles, selling straddles, selling iron condors, and selling iron fly, yes, the IV collapse works in your favor afterwards. But these are a very nice way to have profitable trades. But these trades require margin. They also require management and adjustments if the trade goes against you, which means that if it has an outsized move, okay, you're expecting $3 move, but what if it has a $5 move? It means that you would have to, there would be the option that you sold either on the call side or on the put side is getting tested because it has gone outside the expected move. And then you have to adjust that. You may have to roll it out. You may have to convert it to something else. So these iron condors, strangles, straddles, and iron flies, they require management. They require adjustments. But these are good profitable trades to do during earnings. They become a little complex because of the adjustments. So that's outside the purview of this presentation. So let's go ahead. Okay. Now, we are talking about, okay, Microsoft. I don't know why it shows Snap. It had to be Microsoft. So let's think about what we could have done for Microsoft. For Microsoft, if you think that it has run up a lot, but due to AI, any dip gets bought. So you could think about, okay, you can think that Microsoft goes higher, but it has already, the co-pilot that it was going to do, that was already announced. What more can they announce, right? So you don't think it has a lot of upside left. But because of AI still being the big thing right now, any dip gets bought. Because of this pull and push in Microsoft, you think it goes nowhere. Possible, right? And it is expected to move around 20 bucks. It was at around 350 today. So you are talking about, you could easily do an iron condor. And I said that iron condors, straddles, triangles, these require management. But I can show you an example of how the things are done, right? So for Microsoft, around $20 expected move was there. Today, we ended the day at around 350. So you think, okay, it goes 25 up or 25 down, 20 points. Let's go a little beyond that. So you could sell a 375, 380 call spread. You could sell a 330, 325 put spread, okay, to make it an iron condor for $1.05 credit. So you're getting $150 credit. And so then 350, okay, this is a $5 wide iron condor. So for $5, 150 plus 350 makes 500. So 350 margin would be in your account, would be taken from your account. So that margin is required. You get 150 credit for it. Okay. If Microsoft is between 330 and 375, it doesn't go below 330, it doesn't go above 375. That $1.50 credit you can keep, and the $350 margin is released. Okay. But if it goes beyond 375, you have to play adjustment. You have to adjust your strikes to manage this short. If it goes below 330, you have to manage your short here. I just wanted to show an example of how iron condors can work. Okay. So let's see, I think what Microsoft has done. Let's see. Okay. Microsoft is right where it is. See, it's not gone below. Okay. Microsoft is at around 341, 340. So it is in between, right? So this iron condor, doing this iron condor would have worked very well on Microsoft. Tomorrow, if we are still above, you would be able to easily get at least 50% of the profit from this. That means in one day, you can make $75 overnight. It's like you buy it just before close today, you could have bought it. Tomorrow in the morning, because Microsoft has done within the expected move, the move is within the expected range, the IV will collapse. Your earnings excitement is out. And you should be able to easily get 50% of the credit. So $75 overnight for you to sleep in, you could have made it. Okay, that's the iron condor. That can be a different strategy that you can use for earnings. Okay, now there are other ways to do it. Okay, you think that once it goes down, okay, that was the iron condor. But what, that's after the earnings that you already know, right? What if you think, I don't know where Microsoft goes. Okay, I do not know where it goes, but I think it goes to the expected move, either up or down. Okay, which means it's at 350. If it goes down, I think it touches 325. Okay, if it goes up, I think it goes to 375 by Friday. Okay, you think that if it goes up, it gets pushed towards the expected move. Okay, if it goes down, it gets pushed towards the expected move to the downside. If that is what you think, you could do a call butterfly and a put butterfly. And you would be paying very little money, and wherever it goes, you could have made money. So let's see what it is. Okay. So the expected move we talked about. So you could do a 365, 370, 375 call butterfly for 20 cents debit for this Friday. And you can do a 320, 325, 330 put butterfly for 35 cents debit for July 28th expiration. So you can do an upside call butterfly, which covers the upside. You can do a put butterfly, which covers the downside. Okay. And in all, you're spending only 55 cents. Okay. So if, okay, by Friday, now that we know Microsoft has gone down, say you did both these butterflies, okay, and you've spent 55 cents on it. We are close to 339 pre-market, post earnings right now, right? After the market. So tomorrow, let's say it opens at 339 and keeps going down towards this 330 area. This 35 cents would have already doubled, okay? But if we continue, tomorrow we have FOMC and the market slides a little bit further and we pin at this 325 on Friday. Okay. A $5 wide butterfly, when done with pin, okay, when you're pinning the butterfly, you have a debit spread and you have a credit spread. If it expires right at 325, you can make $5. Okay. So your 55 cents that you paid can become $5 if it pins exactly there. Okay. So if it goes to 370, you would have made $4.45, $500 max profit, 55 cents you take out, $4.45 is the max profit. If it goes to 325 by Friday, then also your max profit is $4.45. Why am I counting 55? Because I bought the call side also and I bought the put side also. Now, if you are, right, if you don't do both sides, okay, if you think, no, everything is priced in, it goes down, but there are dip buyers, so let's just buy only the put side. Okay, you can come up with your bias and just buy the put side. So if you had just bought the put side, you would have only spent 35 cents and you can potentially make $500 on it. Okay, so you can spend $35 to make $500. It becomes a lottery trade. These trades are pinning a strike on earnings by expiration is very difficult because we have movement, right? Either first of all, nobody knows what the earnings is. Even after you know what the earnings is, you do not know what kind of move you can have. It can be a range bound move. It can be an outsized move, right? It can be up or it can be down. So there is so much uncertainty. That's the reason the IV is high, correct? But these cheap plays are low probability because you don't know where you can pin, low risk because there's no margin required, okay? But these are cheap, low probability, low risk, high reward earning trades that can be done, okay? And you just, its expected move was $20, right? Think about it. You don't even have to go to 325 level. If you had done an expected move butterfly for 335, 330, 325, right? We are already at 339. It just needs another $4 push down and your butterfly is in the money. Your 35 cents would already be 3 to 4 times. Even if you, why wait till pin? If the direction is correct, okay, your $35 can easily become $1 or $1.50. I'm happy. I'm happy taking 3 times, 4 times, 5 times. I'm not waiting for a jackpot to pin at that, okay? I know the $35 can be $500, but what if that $35 becomes $150? I'm good with it and I'll be out. The direction, even if it is a little bit in your direction, you can make a lot of money with this strategy, okay? Now, we talked about what kind of earning trades we can do for earnings. Now, there is something, right? When everything is done, all the news is out, there is no uncertainty left. So you can do a post-earnings trade, okay? After the earnings is out, there is no uncertainty. The elevated premium that was priced into options comes out, the premiums deflate. So sometimes it's much easier to just wait for the earnings to come out and then do a post earnings trade, right? When you are doing an earnings trade, like buy something before market closed, earnings comes out afterwards, right? After the market closes, those are lotto trades. Those are speculative trades. But once the earnings is out tomorrow, I know what to do in Microsoft because I already know what kind of move it is already done because of earnings. And now I can do my chart analysis or whatever way is your system to work with. You can do a post earnings trade. But you also need to know that early in the morning when you're buying, all the premium, all the IV that was incorporated into the options because of earnings has not yet deflated. Okay. So you need to be aware of that you are still buying a little bit expensive options early in the morning when you're buying tomorrow. Okay. So a stock can gap down on earnings, can find buyers. The easiest trade in that scenario is to sell puts, put credit spreads to capture the deflating premiums. So suppose Microsoft example, okay, it's gapping down, but you think that dip buyers are going to come, okay, and you don't think it goes below the 320 or whatever, you can sell 310, 300 put credit spread. It would still have inflated premium, okay, and you can sell 310, 300 put spread and make cash flow. This kind of trade does not require to be on your computer all day. Okay. Now let's look at Netflix. Okay, Netflix had gapped down on earnings last week. Its expected move was around 35-40 points. Netflix continued to go down post earnings for 2 more days. So if you are bearish Netflix and think it has run up a lot and everything is priced in, then you could have bought a 440 put before earnings release, and you would have paid $5.10 per contract for July 21st for last week. Your risk is that you can lose $5.01, right? $510 per contract if Netflix went higher on earnings, but it gapped down. So you think your trade worked, correct? But due to the IV collapse, okay, the 440 put the next day was actually trading at 440. Okay. So before earnings, you thought Netflix is going to go down. You buy a put. You buy a put, you're buying for 510. Then it went down. It went down big. Okay. But early in the morning, because the IV collapsed, the same 440 put was trading at 440, not at 5. It went down in your direction, right? It was not trading at $6. It was not trading at 7. It was not even trading at 510 that you bought. It was trading at 440. So you lost money at open, okay? But because it did an outsized move afterwards, because it was a gap down and go, okay? The next day, it kept going down. So you could have bought the 440 put at open at 4.5 and still made money. Okay. So what happens? Why take a speculative trade before earnings by buying a put, which is more expensive, and you don't know the move? Netflix could have gapped up. Then you would have lost the entire $510, correct? But by waiting for the earnings to come out and next day see what kind of gap down or what kind of gap up it is, and then trade in the direction, the easiest way is if it takes out the first 5-minute high, go in the direction by calls. If it gaps down and takes out the 5-minute low, then buy puts. And you could have made enough money that way. And you are day trading. Yes, at that time you're day trading. in the first 5-10 minutes, the IV would collapse even further. And at least now you know the direction that it is going to go in. You are not just speculating, you're waiting for the gap down to break down the 5-minute low to buy puts. So these are the post-earning trades that can be done. Netflix and Tesla were better done as post-earnings because they continued to go down. 2 days later, they were down. Okay. Now, sometimes the gap down on earnings does not bring in more sellers, right? Because it gets to that thing. So another way to trade the IV, rather than selling an iron condor or a put spread, now that snap has gapped down to 10.35, right? Now you think, how much lower can it go? So if you did not do anything pre-earning for earnings in snap, you can actually, the IV is still high tomorrow early morning, right? The 11 put, now you don't have to sell an in the money put in snap. Tomorrow morning, the IV would still be around 250 or so early in the morning. If you think it cannot go any lower, right? Snap gets pulled along with Google because Google is going higher. Snap gets pulled up probably. Then you can sell a 10 put, right? You can probably sell a 10 put for 50 cents or so, but you're doing it after the fact and it's much easier to manage. So sometimes the gap down on earnings does not bring in more sellers. So another way to trade IV is to sell a put credit spread, sell puts, or if the gap is too high and you can sell a call credit spread. So the IV at open is still high. We can take advantage of the high premiums and sell put spreads for a nice low risk trade post earnings. Now let's see what we can, okay? I'm almost 1 hour done, right? So I had prepared my presentation exactly, but I can still talk about it. Let's look for CMG and Meta, okay? How, right? CMG, BKNG, these are pretty big stocks, illiquid stocks. It becomes very difficult to trade, okay? So I usually take butterfly trades for these kind of trades. So let's see what we can come up with, okay? Let's go to Thinkorswim and see what we can do for CMG. I haven't seen CMG, but I know last time it gapped up 200 points, okay? So what kind of, I will look at the option chain and see, come up with what kind of trade we can do. You have two options here. You think it comes down to fill this gap or it goes up for this, okay, fib that I have. Last time, how much move did it do? It closed at, okay, 1780. It opened at 2047. It opened at 1918, but went to 2047, continued for 2-3 days more. So by the week, it ended at 2070. Okay. So you're talking about that we had almost $290 move. If we have a similar move tomorrow after CMG, we already know that it's opened its first franchise in Middle East, right? That's this pop. It was falling like that. This pop that it got was when we came to know that it's opening a franchise in Middle East. So it went from this 2050 to 2170. So it got a $120 pop. So if we get any more information on that and you think that it is going to go higher, how much higher? Can it do the 300 pop like last time? So let's see. It is at 2070. I'll just say, right? It's at 2070. 300 points higher means you're talking about 2370. Think about it. That's my fib, exactly where my fib lines up. So let's see what's this price. It's at around 2350. Okay, let's see. I am bullish. Okay, I am bullish. The IV is 30, almost 90%. So let's see what can be done. You think it does 300 points like last time? Okay. How much would you pay? So if you think it goes about 2200, okay? So for 2200, what are you buying? You are buying almost $2,800 per contract. And how many people are trading there? The open interest is only 166 contracts. Okay. The bid ask spread is from 26 to 32, right? It's like you can drive a train through it. That wide bid ask spread is there. So, for them, for these kind of trades, butterflies has worked. For CMG, butterflies has always worked for me. Okay. It's going to be a cheap, low probability trade, but if it works wonders. If it does not, you're not losing right now. Okay. So let's say it comes to 350, right? 2350. Let's try to see what kind of butterfly trade can be done. If I do 2300, 2350, 2400, I'm paying 95 cents. Okay. Maybe $1, right? You can get filled for $1. Think about it. You are buying a 22, if you bought a 2200 call, just buying a call, that's all that you have been doing till now and not learned any other strategy. The bid ask spread is from 27 to 32. It's $5 wide bid ask spread. So even if you get filled at the mid at around 29.50, okay, you are losing money here just because of the fact that the bid ask spread is $5. If you want to sell it right away, you will not get the same amount, right? So the bid ask spread is $5 and I can do a $50 wide butterfly, which covers me from 2300 to 2400 for $1. Okay. I'm just spending $100 on it. Okay. Two Chipotles, 3 Chipotles right now. I mean, for a family of 4, we spend more than $100 now. Okay. So think about it. If you've been going to Chipotle and you're bullish on it, I'm like, okay, I won't have dinner one day at Chipotle. Take a lotto earnings butterfly for $100. If you think it's going down and filling the gap. Okay. So if you think 300 points is too much, maybe 20 to 50 is better. Okay. Because 20 to 50 is around 19, 20, it's around 20 delta. So maybe this is better. Okay. So you don't have to, you're not paying $1 because it's that far out of the money. Okay. You're paying $1 because IV is high and CMG trades big in terms of the amount of movement that it has. So if you think 2250 is where it pins, so let's do a 2200, 2250, 2300. Okay. Did I do? Yeah. Here you're paying a lot. 2200, 2250, 2300. So this you are paying $5, $500. Okay. So you are still, if you are bullish on it, so from 2200, instead of paying $2,800, you've reduced it to just paying $560. Okay. But you are covered from 2200 to 2300. It's covered. Okay. So that's another way you can do a butterfly. So its expected move is $133. So that's what, right? So if you're talking about $150 from 2100, so you are doing an exactly expected move butterfly. But CMG usually, if it goes up, it does outside the expected move. Okay. Mostly it does outside the expected move. So you don't, to make it little bit cheaper, if it goes up, so you were talking, think about it. Okay, let's think. You want to do 2200, 2220, thinking that you're doing, right? $20 wide call debit spread, you are paying $6.15. But a $50 wide butterfly, which is close to the expected move, right? It was exactly at the expected move that you were doing a butterfly. You were paying $5. Okay. So a debit spread, just buying a 2200 call, you are spending $2,800. Buying a 2200, 2220 call debit spread, you are spending $6.20, right? So $620. But doing a 2200, 2250, 2300, okay, call butterfly, you are paying only $5. Okay, you are getting a bigger, wider margin and you're paying less when you do a butterfly. Yes, you have to be directionally correct. But if you buy a call, you have to be directionally correct. If you buy a call debit spread, you have to be directionally correct. So why not pay less if you have to be directionally correct, but pay less and have a wider net? You are paying less, you have a bigger, wider range, right? That's the reason I like butterfly trades for earnings. Now let's see, what can you do with Meta? I can think about Meta. Okay, Meta has been coming down into this support. I have this as my fib over here. Meta is higher after hours because of Google earnings. Okay, so you can do the same thing. You can tomorrow, because its earnings is tomorrow after close. Okay, you can start. Okay, you think it goes to 320. Its expected move is how much? $30. Okay, you think it goes to 320, 330 area. If you think that, you can do a debit spread. You can start off with a call if you want to day trade tomorrow. Okay, you can start off with a call. Say you can start off with a 315 call for 670. Day trade it. If it goes higher, you can sell a 320 call and try to make it a free trade. That's one option. Another one, you think you can just do a debit spread. You think it goes to 320, you can do a 315, 320 call butterfly debit spread for $1.30. So you're paying $1.30. So the max you can make is, it goes beyond 320. So the max you can make is 370. Okay. So you still have more than two, risk one to make 2.5 kind of. So risk reward is there. That is one way to play. My play has been, I did a butterfly already. Okay, I already took a butterfly trade. It's already active. I was bullish on Google before earnings. I'm like, okay, if Google runs, Meta will run. Then it can get to this 30 level. So I have a butterfly. I paid 20 cents for it. Okay. I have done a $5 wide butterfly targeting this 325 level. I bought a 320 325, 330, call butterfly for 20 cents. Okay. So if it goes down, nothing, right? I lose $20, which is less than cost of a burrito now. But it's already up $5, right? So tomorrow, even before FOMC, even before Meta comes, right? If we start going higher towards 310, there is possibility of me being able to sell this for 80 cents or so. Before earnings, I can already make 3 to 4 times of what I made, what I put in. But if I think it still goes there and it pins to that 320, 325 level, my $20 has the potential to become $5 if it pins at 325. Okay. $20 can become $500. Based on what FOMC says, market starts falling, I can get out for $1, I can get out for 80 cents. Why would I not take my 3 times, 4 times, and not even risk for earnings? So I have been able to do earnings trades like that have made money. And that's what I wanted to share. If you have any questions, let me know. Earnings trades can be traded in so many ways. I have not listed a lot of them, like ratio spreads, straddles, triangles. Those require maintenance, those require margin. There are high probability pre-earnings trades, post-earning trade setups. Calendars and butterflies are low risk debit strategies that can be very profitable. And not many people just, when they think of earnings, they think of buying calls and puts, and then they don't realize that it is high IV, and then they think, oh, it went in my direction, why did I lose money? Or they think about, oh, people losing their shirt because they sold strangles and straddles. It doesn't have to be strangles or strangles, or it doesn't have to be just buy straight up calls or puts. There are many ways, especially low risk debit trades like calendars and butterflies, that can be hugely profitable as earnings trades. So these are my services. I have Discord trade alerts. I have a one-on-one mentoring, options mentoring, and my daily pre-market newsletter that I write. For this event, I am giving, if you use the coupon code TWEET20, you'll get 20% off for the first month. So that's it from my end. If you have any questions, I still have around 10-15 minutes. I can make it 1.5 hours. So if you have any questions, I can answer. To choose the width, do you use ATR range? Yes, I use, you're looking at ATR, which is similar to you're using expected range. ATR is average to range, how much it can move, right? How much it can move, the market maker is using the ATR. The market maker is using the previous times, how much it has moved. All that is incorporated, and that's the reason the IV is rising that much. You won't find Verizon having an IV of 281% because it doesn't move that much, right? Or McDonald's, it doesn't move 25% in one day, but Snap does, Netflix does. And that's the reason Netflix and Verizon, Netflix, Snap, they have that kind of IV. So trading that, yeah, you can say when you're trading an earnings play, you are gambling because it's speculation ultimately. So either do pre-earnings or post-earnings. What do you mean by trade alert example? So like today, right? We got the news that Raytheon, some news came out and Raytheon was going down. So today in my trade alert service, we sold November monthly puts, 90 puts for $7.50. It's already profitable. Then I have a hedge on for FOMC. I'm thinking that if anything, FOMC market doesn't like, we want to test that 4,500 if possible. So I have SPX. I have an SPX put butterfly for I have a 4,450, 440, 4,500, 4,550 for $4. Yes, SPX. So SPX options, whatever trade alerts I take are there. But the Substack, I do a pre-market analysis and actually plan out the trade that I'm going to take for SPX. So the SPX put butterfly was a Substack plan, pre-market plan. But the XLK put butterfly for next week, that is not part of the Substack, because the Substack is only pre-market index, only SPX or QQQ or IWM. So those are the kind of different things I do. The next presenter is here, so if you want, I can stop sharing. How many different trades? I don't do like that. How many trades a week? If there is a setup, I take the setup. There would be times when I have taken 5, 7, 8 trades, right, in a week that have not come off because it's still working. Then I'll stop, because that's my live trading account, right? I am not, just because there is a setup, I will not say that, okay, this is a setup and I'm taking it and I'm actually not putting in my account. So if I have sold RTX puts and I have sold some other puts, my margin is getting used up. And then even if there is a setup, I'm like, I'll post the setup that this post is there, but I'm not taking because I have too many trades right now. Currently, I'm managing those.